Hello, I'm Jared Nelson, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. Of all the macro risk factors bothering investors right now, the most disturbing is inflation. Surging energy prices and a continuing shortage of essential components have fueled a sharp rise in inflation figures across the world. The latest Eurozone inflation data soared to a 13-year high, while the U.S. August inflation stayed above 4%. Investors are now debating whether inflation is really transitory. Some industries, like computer chips, are still unable to catch up with demand. While many companies are suffering from a rise in input cost, which erodes profit margin, a few sectors are benefiting from inflationary pressure. Energy is one of them. Have a look at the energy equity sector as represented by the exchange-traded fund iShares Energy. The $25 billion ETF recently gapped up despite the weak market sentiment. A small rally from here will push the fund to new 52-week highs. Most oil stocks are advancing too. The former largest company in the world, ExxonMobil, outperformed the market as prices rallied to its summer highs. Chevron also rebounded above $100 in recent days. For the two European majors, Royal Dutch Shell and BP, they are developing a classic base breakout formation that suggests more upside ahead. Not only are oil majors benefiting from the cyclical upswing in oil prices, energy service stocks are also climbing in tandem. But for many investors, the biggest question right now is whether the buoyant energy sector is worth buying into. Let's talk about the downside risk first. The biggest elephant in the room, so to speak, is the ongoing energy revolution. Decarbonization of the global industrial system will reduce demand for hydrocarbons. The electric car revolution, one spearheaded by Tesla, is ending the dominance of internal combustion engines. Petrol and diesel cars are being phased out. Even Royal Dutch Shell was ordered by a district court in The Hague to reduce its carbon emissions by 43%. When crude oil prices plunged to minus $37 last year, everyone was shocked and thought the entire oil market was doomed. Negative oil prices decimated the entire oil equity sector. Losses swelled, dividends slashed, and exploration activities canceled. Many thought oil is a sunset industry and assumed that oil majors will soon follow the path of Kodak, a former industry leader that failed to keep up with the times. Over the long term, oil demand will probably plummet due to decarbonization, dragging oil prices with it. After all, why would anyone invest in an industry that is in a secular decline? But the stock market and the underlying industry can diverge for a period of time. This creates dislocation, and investors can benefit from it. Because the energy sector was so depressed earlier, any less bearish development will spark a sharp rally, a rally that is happening right now. The rise in energy prices in 2021 was an outlier event. Most investors did not expect energy prices to jump so far so fast. U.S. crude oil was not supposed to trade at 7-year highs, but it did. And because of this, investors are now scrambling to raise earnings. Some oil companies are on track to make larger than expected profits this year. Look at ConocoPhillips' chart. Does it look like a sunset stock? No. Once an upward momentum is established in a sector, it will probably last for a while. Any short sellers of the sector may need to exit, thus fueling a further rise in the energy stock prices. Plus, with supplies so tight these days, any further disruption to the energy production will instantly spark another spurt in energy prices. Meanwhile, China is experiencing rolling blackouts. The government there is looking to grab more international gas supplies in the coming weeks, which will lead to higher prices. All these factors make the energy sector a compelling medium-term trade. Based on the bullish thesis, should we only stick to the oil majors? The iShares Energy ETF is probably suitable for many because it is a diversified fund. A more speculative choice is the $2 billion VanEck Oil Service ETF, which holds a number of depressed oil services stocks such as Transocean. Outside the U.S., you may want to look at Lukoil, one of the largest oil producers in Russia. The $66 billion stock recently broke out to new multi-week highs. On a wider macro bet, countries with large oil exports may be worth a look, such as Russia as proxied by the VanEck Russia ETF. Given the recent market choppiness, always use suitable risk management for the trade. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.